Hello friends, in this lecture we are going to discuss overview of credit management. So this is part of module D of advanced bank management. Friends, there are certain basic principles to lend. Let us see what these basic principles are. First principle is safety of funds. Friends, whenever loans are given, the funds must remain safe because for the purpose of lending, the banks make use of deposits raised from public, and these deposits are to be returned to depositors. Hence, loans should remain safe. That is the principle of safety of funds. Second principle, purpose. For which purpose loan is being given? Friends, the purpose must be lawful. The purpose should be to lend to a viable economic activity, an activity which can generate cash, which can make profit, and the activity must also be lawful. Otherwise, there can be problems. Third, profitability. Friends, whenever banks are lending, the loans must generate some reasonable profit. Banks make use of depositors' funds on which they pay interest, and in turn they receive interest from borrowers, and the interest paid and interest earned, there must be some reasonable spread. Banks must make profit out of lending so that they can continue their lending and other activities. Now, liquidity. Friends, liquidity means there should not be mismatch in the maturity pattern of deposits and loans. So lending must not result into maturity mismatch. Otherwise, a situation may come where bank is finding it difficult to repay back the depositors raised from the customers. The next principle is security. Lending should be secured so that in case of default, the loan should be recovered from the security. It is possible that borrower does not make repayment of the loan for genuine reasons or for non-genuine reasons called willful default. In such cases, bank can recover the loan only if some security is available. So loans should remain secured. Then another, risk spread. And whenever banks are giving loans, it gives rise to credit and other risk. Hence, the lending should not result in concentration. All the loans must not be given to one particular group of borrowers or in a particular geographical area or for a particular activity. So there should not be concentration. The risk must be widespread, called risk dispersion. Means loan should be given to a wide variety of activities. So these are basic principles of lending. Now after principle of lending, let us go to next part. Friends, I am sure you are preparing your classroom notes. You can stop this video anytime. You can rewind it and complete your classroom notes. Types of borrowers and law governing them. Banks are giving loans to a variety of customers, to different types of customers. And the law relating to those customers is different. Let us see different types of borrowers and the law which governs them. First of law. First of all, individuals. When loans are given to individual persons, these are governed by Indian Contract Act 1872. So the provisions of Indian Contract Act have to be taken into consideration whenever loans are being given to individuals. Proprietorship firms. Again, the provisions are as per Indian Contract Act. So when loan is given to proprietorship firms, again it is just a loan to an individual. Then partnership firms and joint ventures. So these are regulated by Indian Partnership Act 1932. Indian Partnership Act. So the partnerships as well as the joint ventures are temporary partnerships primarily. So the law which guides them is called Partnership Act. Hindu Undivided Family or HUF. So this is regulated by customary Hindu law. So law of succession, etc. we have to take into consideration. Limited Liability Partnership, that is LLP. So there is a specific act called LLP Act 2008 which regulates the limited liability partnerships. Companies. Companies are regulated by Companies Act 2013. This was implemented from 1st April 14. Earlier, there was Companies Act 1956. So the provisions of that act have been revised in the form of Companies Act 2013. Statutory corporations. Statutory corporations are set up under specific act. So the relevant act under which those were set up, those were established, guides the statutory corporation, regulates the statutory corporations. Then trust. Trusts are regulated by Indian Trust Act if it is a private trust, Public Trust Act if it is public trust, and Waqf Act if it is a Muslim trust. So Indian Trust Act or Public Trust Act or Waqf Act. So these regulate the trust. As regards cooperative societies, these are regulated by Societies Registration Act. So there can be two types of societies, those which operate in one state and those which operate in multi-states. So then Society Registration Act of central government and Society Registration Act of state government accordingly regulates the cooperative societies. Now, types of credit facilities. There are various types of facilities. There are various types of loans which are provided to borrowers by banks. Let us see what is their classification. The classification of loans can be in different forms. And first such form can be fund-based loans or non-fund-based loans. Fund-based loans include the loans where the funds are immediately involved, like in case of cash credit or overdraft or bills or pre-shipment loans or term loans. In these loans, the outlay of funds is immediate. Hence, we call them fund-based loans. These can be non-fund based loans also. Non-fund based loans include bank guarantees, letter of credit, co-acceptances, and these can be in the form of commitments like forward contracts. So the first classification is in the form of fund-based loans and non-fund-based loans. Second, in fund-based loans, the funds are immediately transferred to the borrowers. I have already mentioned that outlay of funds in case of fund-based loans is immediate, and outlay of funds in case of non-fund based loans, it is contingent. So the bank commits the funds in case of need. Here the funds are not transferred, funds are not outlaid immediately. So in case of fund based loans, the outlay of funds immediate. In case of non-fund based loans, the outlay of funds is contingent. For example, in case of LC, if documents under letter of credit are paid by the borrower according to terms of LC, then no outlay of funds is involved on the part of bank. But if borrower does not meet his obligation under LC, then bank has to make payment. In that case, the non-fund based loan becomes fund based commitment. Now, fund based loans can be based on time period, such as short term loans, medium term loans, or long term loans. When loans are up to 1 year only, these are called short term loans. When these are up to 3 years or up to 5 years, these are called medium term loans. When these are more than 5 years, then they become long term loans. Other classification can be on the basis of the purpose of loan. So the loans can also be classified on the basis of purpose of loan, like working capital loans, which are given for meeting working capital requirement of the borrowers, or project loans, which are given for creation of infrastructure, creation of manufacturing facilities, then export loans, which are given for export of goods and services, then crop loans, which are given for production of crops, etc. The loan can also be classified on the basis of business segment. So the classification can be segment wise also. These segments can be retail loans, these can be personal loans, these can be corporate loans, etc. Hence, these can be different categories of credit facilities. I'm recapitulating. One classification can be fund based or non fund based. On the basis of time period, the loans can be short period loans, medium term loans, or long term loans. The loan can be also on the basis of purpose, like working capital loans, project loans, export loans, crop loans. These can also be classified on the basis of segment, that is retail loans, personal loans, corporate loans. Well friends, we shall continue with this lecture in the next part also. I'm sure you are preparing your classroom notes. Thank you friends.